The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. We're going to start out the show today. The first chart that I posted into Tiger TV was the chart of platinum because it's making a 61% retracement, which equates to a Gartley sell up here at this 1045 level. But I quickly want to move over to the November soybean chart because Mr. Z was on with John Logan discussing the ramifications of a potential crop problem, which we certainly have going on. But if you'll notice this chart here, late last week, let's talk about it. Early this week, we talked about the ABCD pattern that was forming down at the 61% retracement at that 1072 level. And then as you noticed, we rallied up and stopped exactly at a 78% and 50% swings and then backed off to the 61% retracement into this crop report that we had. And of course, you see that it hit that level at 1093. The low was 1089, and then it quickly rallied 60 cents a bushel on some reduction in acreage for soybeans. There's a totally different story in corn. Corn actually went down and made new lows for the year, folks. Actually, that's not true. It came within a quarter of a cent of making a new low for the year, but I think that'll probably happen in the next day or so. And also wheat. Wheat also made a new low. And wheat, we really need to watch that one coming into this big astro date that we have with this new moon coming in on the 5th of, actually comes in on the 4th, but we're closed that day. But we'll want to watch that very, very closely because wheat is one that responds well, most of them do, I think, but it responds very nicely to the lunar aspects, the full moons and new moons, and we have this big new moon coming in on the 4th of July, which will be a very interesting one. But as you can see from the chart that I've posted in here, we are making a 1.27 expansion on the downside. Now, that is not a butterfly pattern, folks. That's just an expansion pattern to the downside. And if you go to the weekly chart, you'll see that it's making some pretty significant areas of support down here at this 455 level. But you must wait until Monday, which will be our Tuesday, because that's the time to really watch it. This lunar phenomenon in wheat was highlighted in Andrew Lowe's book, The Evolution of Technical Analysis, where he took the first 50 pages of the book and described that the first technicians were actually astrologers. And he went back to the Sumerians and Babylonians, back between 3 and 7,000 BC, and where they had found these stone tablets where they talked about wheat and the moon and eclipses and planning and stuff like that. So it's very interesting if you want to read a book about evolution of technical analysis. Dr. Lowe certainly has a really good piece of work out there that's very interesting, that along with his book, The Non-Random Walk Down Wall Street, which is, I believe, a classic because it proves that pattern recognition, works far better than people might think. All right, let's switch over to the metals market. Usually, whenever something really big is getting ready to happen, I put a limit minder in the market to tell me that it has hit a certain spot. Last night, the number that I was looking at in silver was 1948. And I put an order to sell at 1948 with a 3-cent stop because I didn't think it was going to get above there. It hit 1948, but I didn't get filled. It proceeded to drop 40 cents an ounce. and then rallied back to the 61% retracement of that. But this is the key figure to watch in the silver today, folks, is 1948. Because if we get above that, it's got a chance to go to places where people don't think it can go. And, we're very bullish this long term, but this is the spot where it's going to have a real difficulty in looking at this. If we expand the silver chart and go out even farther, what you'll see here is if we put this long-term chart on silver going back the last 3.5 years, you'll notice that we're making a 61% retracement of the move from 2014 from that September high. That's also a 50% retracement from the high of June of that year. The other thing that's interesting, if you look at that move from 2013 into late 2013, you'll notice that silver ran about $8 around $6 an ounce. And that's exactly what we've run from the bottom here. We've gone from 1350 to 1950, so that equates that same type of a move. We also have a very nice ABCD structure here in the silver at the 1948 level. So this is going to be really interesting, and it's happening at a time when we have all this astro stuff, and that's why I think you're seeing, so much volatility across the board, because it's really got a great deal of things that make you want to pay attention to something that's that's really very, very important. Now, if we switch over and we take a look at the gold market, you're going to see a little bit different picture. The gold market is actually making what we call a perfect Gartley sell signal up here around this 1340 level. I think if you get above 1348, this thing could really take off, but it's so far this has got up to 1341 last night. 61% retracement was 1341, but we haven't backed off at all from that level. But we do have some divergence here between gold, copper, and what's happening in the silver market. Long term, I am very, very bullish this. The question is, it's a little overdone right now, and it's doing it at a time when we're seeing a lot of very important astrological things that I think really we have to pay attention to. And we will be able to, because we have a holiday on Monday. So we've got this 3 days coming in, looking at the 2nd, 3rd, and 4th. And believe me, this will be out of the way. We're going to really start to see some even more fireworks than we've seen in these last few weeks of June than we've seen in a long time. We've seen this in the VIX index, where the VIX rallied to 78% of the high we made last year, and then it's backed off quite a bit the last 3 days, as you might expect, given the fact that the Dow Jones has rallied 700 points without any, actually more than 900 points without any type of a correction at all. So this is basically a radio show about Fibonacci today, folks, because there's so many things happening with the Fibonacci numbers that we really want to pay close attention to. If you recall, yesterday we talked about one of the trades we were watching, which was the British pound. Here again, you'll notice that the British pound low that we made down there at 131.20, that was a perfect 1.618 on the monthly chart that completed an ABCD pattern. And here is the first Gartley that we had yesterday down at that 132, and we're trading about 133 and change right now, which is up 100 and some pips. 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry, powered by the acclaimed with TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, the next chart that I've posted into Tiger TV is the Treasury bond chart going over the last 4 months. As you can see, we're completing this ABCD pattern up at this 175 level. Now, we mentioned the 1.618 numbers and some of these other things that we looked at, like silver and the British pound and a few other things, but the 1.618 expansion on the Treasury bond comes in at 175.15. Last night we hit 175.13. So watch 175.15 today in the Treasury bonds. There's a really huge divergence going on, folks, something like we've never seen before. Now, a lot of you folks don't trade the bonds or the notes, but the notes are by far they're 5 times bigger than the bonds. In other words, the 5 to 10 year notes, even 20, they call them 20-year notes, which in fact they're really bonds. But from 5 to 10 years, where we get our credit card rates and stuff like that. Well, let's not say it that way, but that's how the banks make their money. They never reduce their credit card charges when rates go down, of course, because that affects their bottom line. But we're seeing a huge divergence. I've posted into Tiger TV the German Bund, which is the equivalent to our 30-year bond. And as you can see here, from the top, if you look at this top of this page, the German Bund should be trading at above 170, given where the 30-year U.S. Treasury bond is. But as you can see, it can't even make a 50% retracement of that move. That in itself is something that must mean something, because this is a huge market over in Europe, folks. So maybe everybody's putting their money into the FTSE and the DAX to make that market go up, and they're not interested in the yield anymore. But that's neither here nor there. You've got to pay attention to the fact that this divergence is very, very important. The second thing is, if you'll check the open interest figures from the Chicago Mercantile Exchange, all you have to do is click on CME, click on data, and then click on open interest, and you'll see that the open interest in the Treasury notes has actually declined over these last couple of days, which means there's not any new buying coming in, which is usually not a very strong signal, from a technical basis. So we need to watch that. Now, if we take a look at the notes one more time here, you're going to see what's happened last night with the rest of the markets, going pretty much ballistic. You'll notice that the notes were able to rally up to the 78% retracement at that 134 level. We came within one pip of the exact 134 number, and then we backed off about $500 from that level and have held that level most of the night. So we're seeing some pretty good divergence here, but whether it continues or not, we'll just have to let the people decide, the other traders, because I believe we're going to come in here Monday and we're going to start to see some incredible volatility, and it could be to the upside in the stock market, folks. You cannot take that away from the stock market, because it's held up extremely well with very bad news and was able to come back into an area where it's had some pretty stiff resistance before. Right now, we're that level of 2089 in the E-mini S&P represents the 78% retracement of this whole move down that we had, over these past few trading sessions since we made our bottom on the 27th of June. So this is what we're setting at right now, and we're setting that on the Dow Jones, and we're setting it on the New York. Let's just do one at a time here, Larry, so we don't get too confused and confuse everybody else. We showed the E-mini S&P. Now what I'm going to do is I'm going to show you the this is the IWM, which is the small cap. And as you can see, it's making a perfect 78% retracement of the high from the 23rd, right before the Brexit. And then you saw we had the big break. Now we've gained almost all of that back, and that's also a 61% retracement coming off of the high from June 8th. This ordinarily I would be ready to sell the IWM in here, but because it's a Friday and an up week, and it's the first trading day of the month, and as we know, the last two trading days of the month and the first two trading days of the month are by far the most positive days. I mean, this has a tremendous, I think about 60% of the time, the last 2 days in the month and the first 2 days of the month end up positive. And when you have an up month like we had in June, it's pretty hard for the market to reverse today, in my opinion. Right now we're pretty much flat in the Dow Jones and the S&P, and also the NASDAQ. But this is why I'm waiting until Monday to institute any new positions at all. The next one we're going to look at is the NASDAQ, which is also a very interesting chart if you like Fibonacci numbers. Again, you'll see here on the NASDAQ that we've made a perfect 61% retracement from the high that we made back in early June. If you'll notice the dark blue line starting way back in the middle of April down into May, and then it rallies up into early June. That's an ABCD pattern. And it's absolutely, it's spot on perfect. And now we've had this huge rally over the last 7 trading days, and it's made the market a little bit overbought. We do have lower tops now in the NASDAQ. We had one in June, we had another one in the mid-June, and we're now having one around the 1st of July. But this is early in the day, so you must wait, I believe, if you believe in cycles and Fibonacci numbers and everything else, just wait until Monday, because Monday you'll be able to quantify your risk better. Because if you sold it today and the market's really strong, that's the wrong thing to do from a lot of different perspectives. I mean, it's okay to scalp today. I mean, if you wanted to sell it, but I wouldn't hold it overnight unless the market were to break, sharply today. And by break sharply, more than 150 points down in the Dow. But like I mentioned, the statistics don't hold water for that, because these people that are running these mutual funds and hedge funds and stuff, they do a lot of their buying on the first part of the month. And when you've had a rally like we are, the bias is very heavily weighted to the bullish side. So I would certainly, give it a little bit of time. And all you have to do is wait until Monday, because if it's really strong Monday, the gates are going to open, boys and girls, and you're going to see something that probably haven't seen in a very, very long time. I don't know what that's going to be, but it's going to be something, really, really spectacular. That's the way it looks. The way it looks like to me. So the gold is getting right up here to this 1341 level, which should offer some pretty important resistance. Right now, we're trading at the exact Fibonacci number in the S&P E-mini at 2089.50. If you're going to do that trade, you want to risk about 5 points, $250. That's really all you really have to do, and then you would be able to quantify your risk and know pretty much what you're looking for. If you bought that British pound the other day, it's still got some more to go. Keep your stop at break even, and we'll be right back after these few words from our sponsors.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and one of our esteemed listeners here at TFNN has just posted a interesting statistic, is that the number one up day in the market is July 1st. I'm not sure of that, but you might want to defy human nature, as Jim Twentyman says, and go in and prove that to yourself. I would have bet that it would have been the day after Thanksgiving, because it's such a light volume day and it has a high percentage, better than 75% being up on the day after Thanksgiving. But it could be. If these numbers, are available, if you go look at them, one of the best methods for doing that is to go into Yale Hirsch's book on the statistics of the stock market. If I had my book with me today, I would be happy to look that up, but unfortunately, I'm not able to do that. But I'm sure it's got to be close to that, because the day before a holiday, folks, is a better than 75% chance of the market closing higher. I don't know why that is, but if you go back and look at all the statistics going back to about 1885, when we first started getting really good data in stocks, you'll see that figure has held up well over 100 and some years on a statistical basis. So, and that's in bull or bear market, so it doesn't really make any difference. So that's something that we're looking at right now. The market started just a tad lower today, so that's what we'll be watching. To me, the key things to watch is that Treasury bond number up there, because we missed the 1.618 by 2 pips. The number came in at 175.15, and we hit 175.13. And remember, the notes have they've just barely rallied back 78% and are selling off from that level. And if we take a look at what's happened with the German bond, that looks extremely bearish, because it can't even rally to the 50% level. That doesn't mean it can't catch up, but right now, over these last few days, given the strength in our U.S. Treasury bond, we've not been able to, move any higher than that. So this will have to, like someone says, we'll just have to wait and see what happens, which is why I think it's best to not to put on any major positions today, but coming in Monday, if things work out the way we think they are on this level of the 78% holds in the Dow Jones, the E-mini, and also in the NASDAQ, then we'll have something to look at, because then you'll have to quantify your risk. Remember, this has been a straight up move since the 24th of June, and that tells us that there's been no pattern there except for today. We do see that little butterfly pattern culminating at 2091 in the E-mini S&P. So there's something that's something that you can quantify the risk on, and that's what's going to be interesting about it, is whether it's going to be able to to hold that level or not. But that's why I think we're going to be looking at a situation where we're looking at some pretty interesting things to look at from here. Let's see what else we wanted to mention. I mentioned, let me see. Oh, I wanted to take a look at where we are on this really long-term weekly chart on the New York Stock Exchange Index that we get from our good friend Jim Bartolioni. And if you'll give me 1 second here, I'll be able to get it up and let you take a look at it. And then we will be looking at the market from this level. You'll see that we are right at a retracement, just like we were in 2008. And we'll see if this is going to be the situation, because the time is run out from the downside. So if we happen to take out weekly highs here in the New York Stock Exchange weekly above the old high, then this is certainly wrong, and we could be in an era where we might be up another 3-4 years in the stock market. You can't rule that out. Why it would happen, we don't know, but there's always that possibility. So you want to be as flexible as possible. But we do have this major cycle that I think is coming in here over the weekend, and then we'll be able to to see how the rest of it lines up. We've already made a new high now in the E-mini up above the 2091 level. Like I mentioned, if we get above 2096, this would tell us that this pattern that we're looking at, the 2090 level, is most probably not going to work. But it's the first. You should wait the first half hour of trading in that S&P because it can be skewed by people putting in orders in bulk from hedge funds and also from mutual funds where they want to be in the market, right at the opening. And sometimes that's the right thing to do. Sometimes it is the wrong thing to do. Now, right now, as we speak, we're hitting the exact 61% retracement on the gold on the way back here at this 1340, 150 level. Again, if we get much above, 1346 in this would most tell us that maybe the gold and silver are going to continue going higher and break out all of these 1.618 numbers. Because once you do that, that tells you that the market is most probably, going to have a heck of a run, to the upside. So it's already had a good run, but this is, I believe, what we're seeing here in gold and silver is something that is going to be with us for a long time. We will get a correction sometime along the road, whether it's now or a week or two down the road. We'll get a nice ABCD correction, just like we did in the gold at 1202. We had another one, at 1070, and we'll be looking for those to, potentially to get long, because I think that's where you want to be on the long side of this. But at this particular level, I believe this is you don't want to be a buyer of the of gold and silver in here today, especially with this cycle looming and all these numbers coming together that we see in gold and silver and platinum. And if they break these numbers and go higher, then they just didn't work. But you have to believe in these numbers. That's part of the belief system. If you're working with Fibonacci numbers, you have to look at the patterns and ratios and determine whether this is the spot that you want to be looking at, because gold is still a good $25 under its old high, where we're making, higher highs in silver, and we're making, lower highs in platinum also. So it's not a uniform rush to precious metals here. So, but the key is this cycle that we're dealing with now. I mean, it's a big unknown, and we'll have to wait and see. The people have asked me to talk about the people. I've had several requests to talk about the Bradley model, and this is the same one that I posted here just the other day. It doesn't show that the market has come back, quite a bit, because we're back to the top end of that trading band now, coming in here to July 5th. And this July 5th date, what this means, folks, it means that there are about 14 different cycles that are coming together at the same time. Some of them are astrological cycles, like we have Mars has just turned direct motion, which is a pretty important planet because it's related to the speed, and the speed helps to determine, a change in trend. But we also have a lot of ratios coming from the geometry part of the market, where old highs and lows are connected by these Fibonacci ratios of 1.618 and 1.27 and pi, which is 3.14, and these go back all the way into 1932. They're very accurate. So we'll see what happens on Monday. 877-927-6648.
Today, many commodities are trading at relative lows. And now you can take advantage with Everbank's new limited time, 5-year, market-safe currency comeback CD. This indexed and U.S. dollar-denominated CD offers 100% principal protection and is based on the equally rated performance of currencies of Australia, Canada, Chile, Mexico, and South Africa. These 5 countries are especially rich in commodities, and their respective currencies are poised to do well should commodity prices begin to recover. Keep in mind that no APY, or periodic rate of interest, is paid on the CD. Don't miss out on this innovative new financial opportunity. CDs must be opened and funded by the upcoming July 14th deadline. To apply online and learn more about the CD, including product terms and disclosures, visit everbank.com/TFNN now. This advertisement is sponsored content. Everbank is a member FDIC. It's 2016 and TFNN has a brand new programming lineup to kick things off. Starting January 4th, swim lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin, as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour, sponsored by Nadex. Up next on TFNN.
Okay, folks, I've been asked to talk a little bit about the bonds. I know you know that I'm pretty bearish bonds, and that's the understatement of the year. The thing that you'd want to pay attention to is the fact, we came very close to that 175. 1.618 expansion. As I've shown many times, the 1.618 is the last line in the sand, because once you go past that, you never know where the market's going to go. Now, you'd ask yourself the question, maybe it missed it by 2 pips, which would not be surprising, because sometimes it can miss it by, just 1 or 2 pips. Sometimes it goes over by 1 or 2 pips, but not for very long. So you would say, if that's the case, then if you would take out the low of that high bar when it made 175.13, that means if you put a stop in at 174.10, that was the low of that bar. So that's 100 points, which is roughly $1,100. And if we go below that 174.10, say 174.08, that would trigger you into the trade, and that means that everybody that bought it from the time that it made that high, which would be a period of about 6 hours, would be in a loss situation, which would be a pretty good, place to be if you want to be short. And then you just put your stop above the high, so you're risking roughly $1,100, and then you would see if the market's going to correct from there. We did, one of our nice people here at the Tiger Den was kind enough to go into the Stock Traders Almanac, and indeed, over the past 21 years, the first day of July is by far the best day of the year during that time. So we'll see if what's going to happen. But you're, like we mentioned, you're in an up week. It's going to be just really difficult for the market to reverse today. I think that probability would be higher on the 5th, because those positive days are certainly out of the way. But we're still moving higher, so there's no reason to even think that the market's going to back off. That first half hour of trading is the one that's by far the most important. So we'll see if that's going to to hold through what's going on. They reported today that there are even more and more negative interest rates across Europe, and what they're doing is they're buying our Treasury bond because it's one of the last bastions of yield, because it's still above 2.2, and the long-term yield on the London gilt is only 0.85, so it's twice as much better to buy ours than it is there. Maybe that could be the reason why that's occurring, but I still have to go back to what Bernard Baruch said, don't be concerned on the return on your money, be concerned on the return of your money. One of the emails that I received from one of our listeners is that they were doing a business in Turkey, a technical business related to computers, and they had their choice of being paid in the Turkish lira or the euro. And the Turkish lira is yielding about 12%, and the euro is, yielding nothing. And I said, that was an easy call for me, because you want to get your money out of there just as fast. Whenever they're offering you, like in Greece and some of these other places, these exorbitant rates, there's a reason for that, folks. It's very, very risky, and you don't want to do this. We've seen this in Mexico many times, and I don't know if it's going to continue that way or not across the developing countries. But right now, their risk is very, very high, because they're offering these high rates, and the reason why they give you these high rates is because they're able to say that, yes, there is a great deal of risk involved here. So that's my get off my soapbox, but we'll see. Another interesting statistic that looks quite powerful today is they reported on Bloomberg that ever since Apple has been included into the Dow, it's never been positive. That was really an amazing statistic, considering that almost everybody has an Apple product, and everybody is, it's had more free advertising than any company that I can ever remember in my 54 years of being in the business. I've never seen one that has got that much, have a free advertising, with the exception of maybe Enron and a few others. But on a positive basis, Apple has certainly been one of the best beneficial holders of these things. So those are the things that I'm watching. This is a real key time frame. This is not the day. This is the first. It's just the start of the window that started on June 29th and continues to July the 5th. And of course, we are going to be closed here. We'll be trading electronic, of course, on Sunday, so we'll have a pretty good idea. And believe it or not, folks, the UK does not, you're not going to believe this. You're going to have to sit down when I tell you this one. The United Kingdom does not celebrate the 4th of July. Can you believe that? One of our biggest holidays, and they don't. I just don't understand it. Well, maybe someday they'll come to the table and see if they'll do that. Okay, quick comment here about the crude oil. I still believe we're heading down. We came very close to that 47.70, which was a 61% retracement of this last move. But there's such a beautiful ABCD pattern there, a couple barrels lower at $46 a barrel, that I think we really need to wait to see if that one could come in, because that would be the same pattern that we had in the gold at 1070, and also the same pattern that we had in gold at 1202. So these are the ABCD patterns that Gartley talked about in his book that are so important. That's pretty much what we were doing yesterday in the British pound. And that one now has almost 100 pip profit in it. So, you'd certainly want to move your stop to break even if, in fact, you did get to that level. So that's the main thing. Oh, we got a caller from Dallas, Texas. Mike, are you there?
I am here. You had mentioned earlier that so many countries and central banks were buying U.S. bonds?
Yes.
Okay. Exactly how does that work? And do we have an unlimited amount of bonds? I mean...
Well, sure. All we have to do is print the paper. Yeah, because
Oh,
that's really all you have to do is that they just print the paper and then they have to put the yield on the bond, based on what the price of the bond is. Yeah, but that's really what a bond is. Nothing more than a piece of paper. It's not backed by anything other than the full faith and credit of the United States Treasury. They're no longer backed by gold or silver like they were for many years. So we do have an unlimited supply, and it's easy to see, Mike, because if you go look at the trade sheet or the status sheet of the Federal Reserve, you'll see that they've put $4 trillion into the bond market just to do that. And the way they do that is they issue Federal Reserve notes to pay for the bonds. And then the government pays the Federal Reserve the interest on that, but the Federal Reserve gives that interest, most of it back. I think about 98% of that interest back to the U.S. Treasury, but it's still, that's how the money's created.
okay. And what is the caveat on that?
So the caveat is someday, what if someone decides not to take the paper? Stay with us just a second, Mike. Hold on with us just a minute, okay?
Sure.
Yeah.
Thanks.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to the Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back with Mike from Dallas. Are you still there, Mike?
Yes, I am.
What I'm going to
Yes,
give
I
you a
am.
homework. I'm going to give you a homework assignment. Okay, I want you to
Yep.
reach into your wallet and pull out a $20 bill with the picture of one of my favorite presidents, Andrew Jackson. And if you look at the
Okay.
top of it, it'll say Federal Reserve Note, and then
Correct.
in the body of it, it'll say the United States Treasury. Okay.
Yes.
Now, when Kennedy was president, what he wanted to do was, like Andrew Jackson, take away the Federal Reserve's right to print money. And of course, he didn't last long enough in office to see any of that happen. But what they do is they have control of our money supply. And what people don't realize is it's a private bank, and it's really a very interesting because, you know, it's right on Pennsylvania Boulevard, right down from the White House, and it says Federal Reserve. I'll bet you if you took a poll of everybody in the United States, 90% of the people would say that the Federal Reserve is run by the government. And it is not. It's a private bank for bankers. And so that's what people do. I recommend reading a book, Mike, that is fabulous. It's called The Creature from Jekyll Island. It's when we have the second Federal Reserve Bank from 1913. Andrew Jackson stopped the first Federal Reserve Bank back in 1835 or 37, one of those times. And we didn't have a Federal Reserve until 1913, which was on a Christmas Eve vote. But just read it. I think you'll really enjoy the history of it. The creature of Jekyll Island, and that's an island down in Georgia, I believe, and it's a pretty exclusive resort, much like Greenbrier is in Virginia, West Virginia. But anyway, that's what I would suggest you do.
Okay. Well, I appreciate your comments, and
Thanks
you have a wonderful 4th.
You too, my friend, and I certainly love Dallas. I love everything about it.
Well, it's a little hot here today.
Yeah, well, tell me about it. It was 108 in Tucson yesterday, but we have a little bit less humidity. Thanks a lot, my friend.
Thank you.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.